Hello, Oracles. We've been getting some data coming in more and more recently that kind of point us towards a potential recession. Now, I don't know what's going to happen. I cannot predict the future, but just looking at the pieces that I'm seeing coming through kind of indicate that we're heading in that direction. Hopefully, maybe the Fed can turn it around. Maybe we will get the soft landing that they're preparing for, but truly don't know. So on Wednesday, we just got the JOLTS report. That is the jobs report that we had seen from July. And looking at that, we missed expectations significantly. The market was expecting 8.1 million job openings, and we only saw 7.67 million. So this is also a decrease from June, where there was 7.91 million. So that is a contraction in the labor market, which is not what the Fed wants to see. They have already spoken about how they have seen inflation coming down. They feel like that's under control. Now their big focus is going to be on unemployment and keeping that in line. But in trying to keep that in line, they want to make sure that inflation doesn't get out of control again. So tomorrow we are going to be getting the jobs report with unemployment. Now, unemployment, we are looking at a 4.3% read from last month, and the expectation was 4.1%. That is one of the reasons why we saw that big, massive sell off in early August. So we are expecting a 4.2%, which is still higher than the 4.1% expected in August initially, but lower than that 4.3% that we actually got. So if we end up coming in at that 4.2%, still not a great sign because we still see unemployment moving up, but the rate at which it's moving up is slowing down. If we see the number going above 4.3% and exceeding the expectations that the market has set, that could send us into a bigger turmoil and a lot more sell-off, sort of like what we saw back in August. Now, if we see a read that comes in below 4.2%, we can see some kind of relief in the market coming out, maybe some smaller caps moving up, some of the growth stocks moving up again. But again, we have lower volume and a lot of uncertainty in the market right now, which is why we see the massive fluctuations going on. Typically, when you see lower volume, it's easier to move the market one way or the other. So if you have some big buyers or sellers coming in when there's low volume, then you're going to see those stocks and the market move that much more. Now, in a minute, we're going to go to some historical data that we had discussed a couple years ago when I had Adam on this channel, and we were kind of discussing just historical trends. We see rates getting hiked and rates getting cut. So we'll get into that in a minute. But if you guys like this kind of content, please do me a favor on the channel. Hit that like button down below, subscribe, share the video out there as I'm kind of transitioning the channel to the new focus that I have here with an all-encompassing market approach. Kind of helps the algorithms catch all of that. So please hit that like button down below and subscribe to the channel. So now getting into that data that we had seen before. So again, with the jobs report coming out tomorrow, that can kind of determine what we're going to see from the Fed when we get the FOMC meeting on the 18th. So we could see, if we see the jobs report come in tomorrow and we're higher than expectations, we will most likely get a 50 basis point cut. If we come in at expectations or below, we might only see a 25 basis point cut. Right now, the market is kind of split and balanced where we're going to be at, because after Wednesday, when we got the JOLTS report, the market was like, oh, they were favoring a 25 basis point cut. Now it's kind of balanced. So we're just kind of paying attention to what's going on there. The market is seeing all of this. So now if we end up getting a worse than expected read when it comes to unemployment and the Fed only cuts 25 basis points, that could send the market into a complete spiral downwards. But again, that's almost 2 weeks out, so we have some time to wait. So tomorrow's jobs report is going to be very pivotal for what's going to happen in the market. And I will cover what happens in the market tomorrow night, just to kind of let you guys know my thoughts and opinions on what I saw transpire from that jobs report. Now, going to the historical data that Adam and I had talked about. Now, you look historically when the Fed goes and hikes rates up, the Fed will hike rates. The market doesn't like that at all. And then when the Fed pauses rates, you see a massive rally in the stock market. Now, this rally, because typically when rates get cut, you would think that you're going to be seeing, a big rally at that point, because lower interest rates means that companies can borrow more money. That means growth and expansion. But typically, the market is pricing a lot of that in during that pause period. So when you end up getting to that rate cut point, you end up seeing the markets selling off. Now, it's not that the markets are selling off because the Fed cut rates. Typically, historically, from what we have seen, the Fed cuts rates because something is collapsing within the whole entire economy, and they are cutting rates to be able to counteract that. So we are seeing that going on right now. We're seeing credit card debts being higher than ever before. We are seeing prices of houses still skyrocketing. We're seeing a lot of signs that consumers are struggling to pay for things. Yes, we saw some good retail numbers coming in, but I don't think that those are going to be sustainable because if people don't have money to spend, then there's going to be a problem. Now, average wages are going to be something else we want to pay attention to because if average wages are going up, even if unemployment is at the level it's at, now don't forget, low 4% is still low, but is the rate that unemployment is increasing that is the piece that you really want to pay attention to. But if average wages are going up in line with that, then we still have consumers that have money to be able to spend in the market and in the economy to keep that moving forward as well. But if average wages are staying still or coming down, then that's going to mean that consumers don't have as much money. They're going to be using more credit, which they're running out of at the moment. And eventually we'll hit a wall. Well, consumers cannot spend any more money. That means that businesses are not taking in any more money. That means that manufacturers are going to have to slow things down because retailers and other people out there and businesses are not selling those products. That in turn is going to be that deflationary pressure. And then we see GDP go negative. That is a recession. So we're just kind of seeing that spiral. And then as that all happens, companies bringing in less revenue means that they need to cut expenses to keep paying the bills and keeping that bottom line growing. Typically, payroll is going to be that number one expense. You start cutting payroll, that means unemployment goes up. When unemployment goes up, that's less people that have money to spend. That in turn just kind of triggers that further downward spiral going forward. This is the trend we have been seeing going on over the last few months. And again, that's why this jobs report tomorrow is going to be so important. And so, again, going back to that historical trend, Fed cutting rates this time around, they're cutting rates in 2 weeks. We probably won't see any sort of collapse in the economy between now and then that is going to trigger the Fed to say, oh, we need to cut 3% on the rates. But if they cut 25 or 50 basis point, that might not be enough. It does still take 18 months for rate hikes to take effect. It hasn't been a full 18 months since we saw that last rate hike. So, with that said, we still have some time of those lagging effects to take place. Those lagging effects taking place means that a 50 basis point cut is still going to take some time to truly affect the market in the long run. So we still have 4 or 5 months of pain, which could put pressure on the market even more during that time to finish this year off. That could be enough for that tipping point, and then maybe in early 2025, that's the point where we see the economy not doing well and the Fed has to do a massive rate cut. Maybe we see a 1 to 1.5% in Q1 or Q2 of next year because the Fed now needs to try to get out in front of all of the unemployment that is going on and the economy collapsing. So again, I don't want to be out here and be the bearer of bad news, but these are just little things that I'm paying attention to, kind of things that I'm preparing for. See, people like Warren Buffett has $277 billion of cash sitting on the sidelines because he doesn't know what's going to happen. Now, when it comes to Warren Buffett in that standpoint, it's not because he thinks we're going to be getting into a recession. For him, he has stated as well that he sold off a significant chunk of his Apple position, not because he doesn't think that the company is going to do well, but because they have insurance rates that are going up significantly. So he needs to make sure that they have enough money that can cover any incidents and the insurance on all of the stuff that they own. The other piece is going to be because if Harris wins the election and her proposal to go up on taxes on corporations holds true and she ends up pulling it out and goes up to 28% plus, he wants to make sure that he has that money on the sidelines to cover those taxes. On top of that, if they're going to go up on capital gains taxes, he would rather sell off those Apple shares now, take that profit now, and pay less taxes on it later. When you have that kind of money coming in, and even for a smaller portfolio, it's very important to pay attention to taxes when it comes to your capital gains and any investment gains that you make, be it dividends, capital gains tax, or whatever. Be very cautious of that because taxes can be expensive. So for Warren Buffett, he is paying attention to that significantly because for him, paying an extra 5% on taxes is a lot of money. That's billions of dollars that he could be paying or keeping for himself, depending on what ends up happening with the election. So he's keeping that money now. So now he's made that money, and the capital gains tax will be at this guaranteed rate now that he has it at versus a potentially higher rate in the future. Plus, he has more money on the sidelines as well in case that corporate tax goes up so he can cover those also. So he's just kind of protecting himself on that standpoint. And he also thinks that the market valuation is a bit frothy at the moment, and he doesn't see any values right now to spend that money on. But if we do get into a recession, he's going to have plenty of cash sitting on those sidelines to buy whatever he wants. Because in a recession, you typically see a lot of great opportunities to buy stocks and companies that are going to boom coming out of it. And a lot of the Mag 7 companies are companies like that. Apple stock itself, let's say we hit a recession, maybe it drops 50%. He can then go ahead and buy back in at those prices that he sold it before. Maybe he doesn't. Who knows what's going to happen? But he has cash on the sidelines for opportunity. This is why I constantly say to you guys, my strategy had switched from where I was going strictly growth and mostly Tesla stock to cash flow generation and cash on the sidelines because I want to be ready to take advantage of opportunities. The lessons I learned by holding Tesla stock the way I held it was when there were opportunities, I never had cash to take advantage of any dips that were out there. So I still love Tesla. I still want to own more of it in the future, but I want to be ready to take advantage of any more opportunities. And I think we still have some opportunities that lie ahead of us, not just for Tesla, but for a lot of other companies that are out there. So again, looking at the jobs report tomorrow is going to give us that indication if we are going to be seeing more of those opportunities in the future when we come to next year and maybe 2026, if we are going to get into a significant downturn in the economy. So, this is my preparation. For those of you guys who have been following, I'm now on phase 9 of my entire strategy. This is phase 9 through 10, and then I hit level 2. And again, I will make a video for you guys at the end of every month explaining what I've got coming in for dividends, and I'll do a full breakdown at some point of what my entire strategy is. I did a quick brief video on it earlier, and I'll do another more thorough one on it later to show you guys kind of how I do it. And it takes all of the stress for me completely out of it. I found that when I was trading with Tesla, I was a long-term shareholder, despite the fact that I sold out a bunch of it recently, just because I saw what was going on with the stock itself, and I wanted to present myself more opportunities for it in the future. But my emotions were really getting tied up, and I made plenty of videos in the past helping you guys get through those emotional times as well. But for me, I don't want to have to deal with that. I don't want to have to try and wrestle with those emotions. And I love sharing with you guys. And I will still do that on here and help you guys as well when it comes to those emotional roller coasters, especially if we get into a recession next year. There's going to be a heck of a roller coaster going on. And I will absolutely be here for you guys. But I wanted to take myself out of that entirely. And the strategy that I have set up for myself does just that. I literally see numbers on a spreadsheet that say, I have X number of dollars to spend. I can spend it on these X number of stocks because these stocks and ETFs are underperforming, and they're not underperforming because the fundamentals have weakened. They're just underperforming just because it's been selling off. And again, buy low, sell high, or just buy low because it's on a discount. And the way I look at my portfolio now is I'm literally buying income at a discount. So when I see a stock or an ETF that says, hey, I can add $10 to this, that means that, ooh, this is now on sale. I am going to be buying more income for less. It is strictly how my strategy works. No emotions whatsoever. I just do my due diligence and research to make sure that all of the stocks and ETFs that I'm buying are strong, the things that I want. It's a diversified portfolio. I just follow what it tells me to do. Very simple. So I will share that in the future with you guys when I get a chance to sit down and really truly break it down for you. And I will start doing some live streams again as well. You guys can let me know in the comments below when is a good time for you guys for live streams, because I can get in here and then we can have this conversation. I can show you guys my entire strategy, and I'm not one of those. I don't have like, different courses that you could go into. I'll completely share with you guys what I have for free on here. Ask me other questions you have in a live stream. I'm totally open with you guys on that. Doesn't bother me at all. I just like sharing with you guys and giving you my knowledge. I do have a Patreon. I don't do a lot in there. I've been kind of sharing that spreadsheet on a weekly basis. And I apologize to some of you patrons that are out there. I need to get updated on that. I'm kind of getting back into things, so I will get that back out there for you. So I'll get that in there if you guys want to see that full spreadsheet. Eventually, at some point further down the road, I'm not making any promises, kind of like Elon with FSD, 2 weeks. That's not going to happen. But I will get that spreadsheet so you guys can see my entire strategy and be able to download that spreadsheet and use it for yourself. My spreadsheet that I have is for all of my finances, all of my detailed spending. It goes into a P&L that I've created for myself. It's a profit and loss statement that I have. So I create my entire budget for the whole year, and then I track all of my spending to make sure I'm staying within that budget. Basically, like reading an earnings report for a company, I have created that for myself on my own personal finances. And at some point, once I get it finalized, I'll share it with you guys so you can take it for yourself as well and have your own profit and loss statement and your own earnings report for your own personal finances and your portfolio. So that's all I've got for you guys today. Let me know what you think about the jobs report coming out tomorrow. Let me know how you think the market's going to be reacting to it. And let me know if you guys think that we are going to be getting into a recession in the next 6 to 12 months and how you are preparing for that if you think we're going to get it. Thank you guys so much for watching. I appreciate all of your support. Have a great one.